I think I have. I think we're going to. We just while we're collecting, there are some questions already received earlier, and I will address this with. Actually, I started off with Edmund. Yes, yes. In terms of, there was a question talking about different views of the U.S. dollar, the Australian dollar. Different views of the Australian dollar. Some say that it's parity with the U.S. dollar by year end. But with carry trades of the Australian Japan, would it not maintain its role and climb further? What are some of your thoughts and comments in terms of the views of the Australian dollar?
Thank you. My personal view on this Australian dollars, there are a few points to take note and to watch out for the traders. Number one, Australia tend to benefit from China's import. So we have to watch whether China recover in the second half of the year, and if they recover, they will import more, and that will help Aussie dollars. You can see at the moment, Australian dollars compared to Canadian dollars is benefiting from the recovery of USA, but Australian dollars is weakened because of the China economy is not doing so okay. To be more specific to answer to that question, we have to watch out for the China, whether they recover in the second half of the year, which will benefit the Aussie dollars. Second thing to look out for will be the ending of the QE, or at least the scaling down of the quantitative easing by the US central bank. That will actually strengthen the US dollars if they scale down the QE or end the QE by the end of the year. And if that happens, parity is definitely on the card. That's my thought.
Obviously, when you look at US dollar, Australian dollars is never, when you look at actually currencies, it's never just a straight currency. Now, and so looking at Australian dollars, how, and then if traders want to take advantage of that, which are the currency pairs should they be looking at?
Very good question. I think at the moment, the clear trend will be Aussie versus the yen, because yen is depreciating because of the large-scale quantitative easing taken by the Japanese government. And they just started this QE not long ago, and looks like it will continue for a while more, and which means that yen will continue to come down or weaken further in the near future. So because of that, I think Aussie against yen, the trend will be an uptrend. Once in a while, there will be some correction, but it's supposed to be a temporary correction.
We're going to put this question next to Daniel, and perhaps I'll ask your view as well. I think people always like in terms of what do you see in terms of the outlook for the STI over the next 12 months to a year to 2014? What are some of the
Okay, just now I talked about the STI. Regarding the second and third quarter, we think there will be a correction. A correction whereby if you put it into points terms, it will be around 10%, okay, 5 to 10% correction. That's a good correction. However, we still think that the bull market hasn't ended, okay, especially since the interest rate is kept at 0%. So our suggestion is that, okay, do have cash at hand. Once there's a correction, it's an opportunity for you to go and buy, okay? Bear market has not come. It won't stretch to 2.5 years. So possibly it's around 2 to 3 months correction. That's a tentative gauge, okay, for everyone. Thank you.
I'm going to ask Edmund the same question, because the idea here is to get the different perspectives. It's not one answer. So good, all have one answer, all sure win already, right? So let's look at the perspectives here. Edmund.
Thank you. My view is that we could potentially see a correction coming over the next few weeks, probably triggered by the pullback in Dow Jones, and the support on the Dow Jones is quite far away, around 14,382, which is a few hundred points away. And if that happens, STI will pull back. But the first support will be around about 3238, around there. I think it should hold there for a while more. If that breaks, the next support should be about 3050. I agree that the bull run is still very much intact, and the correction should be mild, and it should be temporary. at least for the first half. For the second half, I think the third quarter should be still okay, but the fourth quarter, potentially there will be talks on the ending or scaling down the QE by the US. If that happens, market will take that as an excuse to sell down. So I think second half, especially the fourth quarter, we need to be more careful. And in terms of the STI components, not all the STI components will be equally doing well. The banks, I think, are still doing very well. You look at the UOB, you look at the OCBC. They're benefiting from a lot of inflow of funds because a lot of Europeans, they don't trust their bank. They'll bring their money to Asia. And also, they'll invest in yield REITs, which will give them good yield. So this sector, the financial sector, tend to be doing well. But those cyclical, like Olam, Noble, or this type, which is more cyclical, we need to be more careful. That's my view.
Thank you. Can I ask Edward some of your views in terms of the outlook of the STI over the next 1 year after 2014?
Okay. My view of STI over the next 12 months, I would say that the top side, yes, though there are biasness towards the top, but I would say that it has its limitations. From the chart I illustrated earlier on that we are on the Fibonacci 76.4 levels. And right now, we have been sideways trading for at least a couple of weeks. So there is definitely, considering that some of the imminent negative issues in the Eurozone were not settled, and it's not going to be easy. Economic data releases in terms of Asian economies have picked up, but how much more of this upside can it progress in terms of the STI, considering the bearish clouds in the UK, in the Eurozone areas? In saying so, though it sounds a bit bleak in terms of this conversation, but there are several so-called positive tones that are made changed in the current situations. We look at the few crises and the few rallies back in the past history of about 20 over years. We see that most of the corrections, or even, let's say, the solutions done to the economies would be easing measures, singular company, I should say, singular country, as well as adjustments on interest rates, adjustments of currencies. But at this current point, what is the countries, global economies doing to sustain the economy? Printing money. US started, Eurozone started, UK started, Japanese started. So I believe that such factors would be the supporting so-called reasons for market to still hold on intact on the bullish uptrend. So in terms of the forecast at this point of time, I would still say a little equal in strength that the UK are trying to so-called improve their situations by possibly adjusting the interest rate to stimulate exports. US has been doing relatively well, considering that they have met the objective of decreasing unemployment rates. Eurozone, still the immediate threat. So given at such, considering Asia picking up as well, such situation flows, the focus has always been on Greece, Portugal, Italy, Eurozone to be specific. And how much can this negative sentiment so-called hold on to the global economy to push it down, or to so-called remove all these immediate threats? Would it be easy to let the STI flow upwards? This is yet to be known, considering that the market situations have changed from the past. So in my view, I would say that at this point, that we are situated on the current peak based on technicals of the STI. I would say that this correction, I would personally put a short-term biasness downwards. Correction, as I agree with the previous speaker, that it won't be large, considering the factors that, the quantitative easing has been ongoing through the various countries around the world globally. So in terms of topside potential, unless there are concrete evidence to say that immediate threats from from Eurozone can have a conclusion, then I would think that there are more upside biasness. If not, I would still think that it's going to be sideways trading till the end of the year.
I'm going to ask Rahul his point of view as well in terms of his views in terms of the STI outlook for the next 12 months.
Thanks. I'm going to give a very boring response, but the beauty of this response is that it's consistent anywhere we're asked this question, and that is that we believe that you should have a well-diversified asset allocated portfolio and sort of adopt a long-term approach and sort of not look at sort of short-term cyclical ups and downs in the market and sort of invest on the basis of that. Rather than that, sort of make sure you have a broad allocation, right? Think through your asset allocation and then sort of invest for the long term. So if Singapore is sort of a core holding in your portfolio and you're here for long and you're investing in it, right? We sort of adopt a passive approach there, long term, and then you can sort of take specific stocks and sort of trade around the peripheries there. So the analogy we like to use is, I'm not sure if a lot of you follow soccer, but in soccer, when it comes to penalty shootout, the goalkeeper thinks the way he needs to do something is to jump left or jump right. Okay, but if you did sort of a statistical study, if he stayed put where he was and didn't just move right or left, he'd have a higher chance of saving the goal. All right, so that's sort of the concept we apply to sort of investments as well. I know that's not specific and exact to sort of what sort of the other speakers covered, but that's sort of just more a philosophical point of view from Vanguard.
Okay, sticking with Vanguard, there was a lot of questions regarding ETFs. And even the earlier speaker, Adam, brought up in terms of there are such ETFs like inverse ETFs. And then we also hear that there are synthetic ETFs. Could you just perhaps for the audience explain in terms of the difference in these ETFs and the risks of the ETF products so that investors need to understand before they are putting their money in it?
Great question. So I think all ETFs, so what I talked about was very high level, what are ETFs, what are the trends in ETFs, but it's very, very important when you buy an ETF, you know how that ETF is being replicated. So there's two ways you can do it. Either you can buy all the stocks, right, in the index and hold them in the same proportion as the index, so that's called physical backed, or you can buy something called a synthetic, where they don't buy each and every stock, but it's basically a counterparty agreement, usually with an investment bank, that promises the returns of the benchmark to you, right, in exchange. So it's basically a structured product. Now, of late, ever since the Lehman mini bond crisis, more and more sort of advisors and institutional clients have moved away from synthetic because there's a huge counterparty risk, right? What it means is if you hold the ETF and there's a counterparty agreement and that counterparty goes out of business, then you lose all your money, right? Whereas with the physical, you own the physical stock, so you can actually sell out of each stock, and there's just less risk involved. Inverse ETFs are all these are sort of much, much riskier products where you're basically counting on the market going the other way, right? So if the market moves in the wrong direction, you're significantly exposed. So all ETFs aren't built the same. So to the extent that you go into ETF indexing or thinking about indexing, always ask the question about, as I said previously, cost, right? What is the underlying, and how closely is that particular index tracking its benchmark?
I'm going to go back this side in terms of ask, because I thought a lot of questions on gold. I'm going to start with Edmund and also ask Daniel in terms of gold. It's broken the 1500 level. What's next? Looking at gold, what are some of the outlook for gold? Would it drop to 1200, 1000? Or what are your thoughts?
Thank you for the question. I'm bearish on gold. Gold has a very strong support at about 1520, 1530, that zone, and it was tested many times last year when there was a big sell down, but the support holds. This time, the support breaks, and it's an extremely bearish situation where this strong support was broken, and the downside, it could be quite significant. I suspect, my personal view, watch out for the level around 1218. This is my point number one. Point two, if the dollar is strengthened further at the end of the year, and dollar tend to have an inverse relationship with the gold, it's again another bearish factor for the gold. Third, if US, the recovery continue and Europe side stabilize, the risk sentiment will actually improve. That means people will tend to not to buy gold as a hedge. So all these three factors actually are all bearish for gold. So personal view is that to me, I think the gold rally is over for the time being at least.
Daniel, could you have your thoughts, please?
Yes, actually we have the same view. In fact, 1 year ago, my mentor, Mr. Hu Liang, said that 1910 is probably the highest point you will see for the next 20 years. Okay, I think just now Adam did a very good job. He showed the gold so-called trend for the last 40 years. Okay, it has been on a parabolic shape going up, then it has come down. Okay, so especially for commodities, there's always a cycle. It's for example 10-year bull run followed by a 20 years bear run. No matter what commodities, there's always this type of cycle. So the thing is, it's on a long-term bear trend. However, having said that, for gold, how are you going to know the next support? You take the highest point, okay, multiply by 0.8. Gold always travel in boxes, okay? It goes up in boxes. The last time it goes up is 1440, after which is 1800. But the thing is, the last burst, okay, last year, is because of QE3 expectation. It happened, however, gold hasn't rise up after that. Then the thing is, the next support will be 1440, whereby I think there will be a very strong support. There will be a temporary rebound. However, do not go in investing long-term in gold anymore. Okay? Thank you very much.
Okay, great. I'm going to quickly move on to Edward here. Share in terms of, there's a question here about the different markets, and looking at the global market, gold equities market is moving up for a fairly long while right now. Some thoughts in terms of what could derail this current uptrend? Which markets are at a higher risk level of a downturn or risks? Which markets would have a higher potential for an upside?
Okay, in this aspect, I would say in general, I believe in technical analysis very heavily, and in terms of that, we speak about the momentum of the price falling or rising. So at this point, if we talk in terms of correlations between, let's say, the Eurozone markets in comparison with the STI. STI has moved up to a peak, as I mentioned earlier, and we have been raised with several considerations as to what will be our forecast, whether it will be upwards or downwards. In Singapore in particular, I wouldn't say that this would be the #1 pick in terms of downward move, because in terms of economies, it's well supported by various export factors, and then in terms of our currencies, it's well maintained by MAS in terms of currency adjustments to attack inflations and also to stimulate exports. So our home country, very well intact with supporting levels for the upside potential and downside limited. And if you were to ask me to pick, let's say, which one would face a more drawdown, a bigger downturn, it would still be in the sense of, let's say, US in particular. Though it has been relatively strong, but you can see that statistically, unemployment has been increasing, but the growth, GDP growth, has yet to realize its stability. So in order for it to be stabilized, the price of US dollars has to depreciate to a certain level that will be acceptable to stimulate enough exports to overcome the debt deficits. And in order for that to happen, of course, the global economies have to do well. And why did I pick US in particular is because they have risen up substantially against the rest of the markets. And if you were to move up fast, in technical analysis, if you move up fast, over a short period of time is not a reasonable basis of time. If you move up fast within a short span of time, the tendency for a drawdown or correction will be high because the massive buy-in, it's all pricing based on expectation. So if your expectations were not met due to maybe certain economic situations that arises in the future, definitely those are the assets that you're going to sell first because you are buying on a high, so-called holding on higher risk. So I believe this would be my two picks against, let's say, home country stability versus the US market for erratic move up. And on the Eurozone markets, both of them, most of them has been trickling downwards gradually. I mean, this is expected. So I wouldn't see any more upside potential unless, on short term, Cyprus issues were resolved, Portugal new issues were resolved. So these are the two that might create so-called a technical rebound. Other than that, it's still a long-term biasness for downward movement.
Okay, you've heard the man. I didn't say it. Long-term downward movement. So, but what we're going to do is, I'm just going to, before we wind up, Rahul, Vanguard. I mean, a lot of people saying we haven't heard of Vanguard. Can you trade Vanguard products in Singapore?
Yeah, we get that question every time we go for sort of a retail seminar. So the answer is yes. Our US ETFs, and we have now ETFs trading on the London Stock Exchange. You can go to your brokers and ask them if you can buy the product. So it is available for investors here, but you just have to sort of go to your broker and ask them for which ones are available. They're predominantly sort of US in nature. So to the extent that you're interested in the US market, there's some international in there, but most of them are for fairly well-diversified portfolios.
What we're going to do is going to ask this question, what is the one key takeaway we're going to ask all for investors to take note of from your point of view during this current times? I'm going to ask Daniel to give this point of view first. What is the one key takeaway from your point of view?
Regarding the market?
Regarding the current situation in the market right now for investors.
Okay. The thing is now it's best to have cash at hand, wait for the correction to come. Okay, that's my only sincere advice. So the thing is, Dow Jones won't go up within 1 year. It won't go up 12 months. Okay, it has went up consecutively for 5 months already. I think a correction is about to come. It's just the magnitude. How heavy is it? So the thing is, it's best to have cash at hand. Of course, Dow Jones will definitely affect STI. Okay, it will definitely affect the stocks you have. Okay, for short-term traders, my view is better wait for opportunities. Okay, for long-term traders, okay, you may continue to hold your stock because you are not a short-term trade. Okay, so the thing is, you may so-called hold through the so-called correction. It won't be a deep correction, just a slight correction. So you can hold through it, have your dividends. So firstly, you need to determine what sort of player you are, okay, before you decide what is your plan and strategy. Yeah, thank you very much.
Edwin.
I think the key takeaway that I would like to mention is probably it's time for some of the traditional investors also to look at CFD, because CFD allows the trader to trade both directions. It could be long or it could be short. If uptrend is long, downtrend is short. So it serves the purpose of giving you the flexibility of going both directions, and also serve the purpose of hedging your stock. For example, you have a stock, but you know that the trend is coming down, but cutting loss could be expensive. You may use CFD as a way to hedge it. That means you can initiate a short position to cushion that fall. So then the key takeaway is that you may want to take a look on the CFD product that IG can offer as a way to manage your portfolio in terms of going both directions and hedging. Thank you.
Edward, what is one key takeaway from your point of view for investors during this current times?
Okay. In simplicity, I would say that I agree with all the speakers over here that you should have cash on hand, but at the same time, idling would not help. So I would say invest in knowledge. That's one key takeaway that I would like to say, because we have a lot of speakers with good knowledge, expert in their own fields, and then we know that consensus is there's bound to be a correction, just that we do not know what's the magnitude. So while waiting, why not we hone our skills in terms of our analysis, in terms of the way we trade, etc. And then maybe we can actually make a better trade when it's time.
And Rahul, from your point of view, what is the one key takeaway investors should be taking for during this current times?
Yeah, I think sort of agree with the previous speaker on sort of the education theme. So really sort of constantly sort of educating yourself, pushing your comfort zone. So that's something Adam talked about. But I think more like it's very hard to tell, over periods of time for people to tell which way the markets are going, okay? You can try it, but doesn't mean you'll necessarily do it right. So the idea is, try and shy away from, making very bold predictions or putting a huge risk on sort of where the markets are going, because that's sort of akin to gambling unless, you know exactly, you have information that the market doesn't have. So having sort of a well-diversified long-term approach as your core, and then sort of having sort of more active or sort of that mentality of trading around the periphery or the satellite is what we would sort of recommend in any market situation, not just the current one.
All I can say is don't put all your eggs in one basket. Simple. All right, thank you, ladies and gentlemen. What I'm going to do is to give my panel a round of applause. We have come to the end of the evening. It's about 6 o'clock. Thank you very much for staying, and have a good evening. And for those of you who will see you tomorrow, we start at 9 a.m. here again. And if you appreciate your feedback forms. Thank you very much, and have a good evening.